Here is a fact most people in HR have never told you. The HSA, the account most people treat as a medical expense wallet, is mathematically the most tax-efficient retirement account in the entire U.S. tax code. More efficient than a 401k, more efficient than a Roth IRA, and most people with access to one are using it completely wrong. Today we are going to run the numbers on both, side by side, and show you which one actually builds more wealth, and in what order they should be funded. Let us start with the structural difference, because it is more dramatic than most people realize. A 401k gives you two tax benefits. Your contributions go in pre-tax, which reduces your taxable income today, and the money grows tax-deferred, meaning you pay no taxes on gains while it is sitting in the account. That is a strong deal. But when you pull money out in retirement, every dollar is taxed as ordinary income. Two tax benefits in, one tax hit on the way out. The HSA gives you three tax benefits. Contributions go in pre-tax. The money grows completely tax-free, and withdrawals for qualified medical expenses come out with zero taxes. Pre-tax in, tax-free growth, tax-free out. That structure, the triple tax advantage, does not exist in any other account in the U.S. tax code. Not in a 401k, not in a Roth IRA, not in a traditional IRA. The HSA stands alone. Now let us put numbers on this. You earn $100. You want to use it to pay a $100 medical bill. If you route that $100 through a 401k, you contribute $100 pre-tax. It grows, and when you withdraw it to pay the medical bill, you pay roughly 22% income tax on the withdrawal, leaving you $78. The government took $22. If you route that $100 through an HSA, you contribute $100 pre-tax. It grows tax-free, and when you withdraw it for the medical bill, you pay zero. You keep all $100. Every dollar. That is a 28% improvement in spending power on healthcare costs from the HSA compared to the 401k, on an identical dollar amount from the same pre-tax income. That gap does not disappear over time. It compounds. For 2026, the HSA contribution limit is $4,400 for individual coverage and $8,750 for family coverage, up from last year. The 401k limit is $24,500 for 2026, with a catch-up of $8,000 for those 50 and older. Those are dramatically different limits. The 401k lets you shelter far more, but the HSA's efficiency per dollar contributed is higher. But here is what nobody tells you about the HSA. Most people are using it as a debit card when they should be using it as a retirement account. And that difference, over 30 years, is worth nearly $1 million. This is the move that separates people who understand HSAs from people who just have one. Most HSA holders treat the account like a medical debit card. Bill comes in, they swipe the HSA. Bill paid, money gone. The triple tax advantage delivers its benefit in the moment and stops there. The account balance stays low. It never compounds. It never becomes a retirement asset. The smarter strategy, what financial planners call the stealth IRA approach, works like this. You enroll in a high-deductible health plan, which qualifies you for HSA contributions. You max out the HSA every year at $4,400 individual or $8,750 family. And then you pay every current medical expense out of your own pocket, from your regular bank account, and you save the receipts. Every single one. Meanwhile, inside the HSA, you invest the full balance in a low-cost index fund. Most major HSA providers allow this once your balance crosses $1,000. You let it compound tax-free for years, decades if possible. Here is the part that most people find remarkable when they first hear it. There is no expiration date on HSA reimbursements. A medical expense you paid out of pocket in 2026 can be reimbursed from your HSA in 2041, completely tax-free, as long as you have the receipt. That means you can let your HSA grow for 15 or 20 years, then pull money out tax-free simply by producing a receipt from an old medical visit. The IRS does not care how old the expense is, only that it was a qualified medical expense incurred after the HSA was opened. A 35-year-old contributing the maximum family HSA of $8,550 annually for 30 years, invested in index funds averaging 7% annual return, would have nearly $1 million in an HSA by age 65, and every dollar withdrawn for qualified medical expenses would be completely tax-free. For context, the average couple retiring today faces over $315,000 in healthcare costs through retirement. With a fully invested HSA, that entire $315,000 could be withdrawn tax-free. From a 401k, that same $315,000 in medical bills would be withdrawn as taxable income, costing you $47,000 to $75,000 in federal taxes at a 15% to 24% effective rate, depending on your bracket. That is not a rounding difference. That is a $47,000 to $75,000 swing on a single category of retirement spending. Now here is where the 401k fights back, because there is one thing it does that the HSA simply cannot match, and it is the single highest return move available in all of personal finance: the employer match. If your employer matches 4% of your salary and you earn $75,000, that is $3,000 in free money deposited into your 401k every year, as long as you contribute enough to trigger it. That is an instant 100% return on the first $3,000 you contribute. No investment, no tax strategy, no financial decision of any kind can beat a guaranteed 100% return in the same year you make it. The HSA's triple tax advantage is genuinely superior dollar for dollar on tax efficiency. But the 401k's employer match is not about tax efficiency. It is about free money that exists the moment you contribute. And if you prioritize the HSA over the 401k match and leave that match on the table, you have just walked away from a guaranteed return to chase a tax benefit. That is the wrong trade. The 401k also wins on sheer contribution capacity. At $24,500 per year compared to $8,750 for a family HSA, the 401k allows you to shelter more than twice as much income from taxes annually. For high earners in the 32% or 37% bracket who want to aggressively reduce their current taxable income, the 401k's larger contribution room is the more valuable tool, even with its single tax hit structure on the way out. And the 401k has no eligibility requirement attached to your health insurance. The HSA requires enrollment in a high-deductible health plan. For 2026, that means your plan must carry a minimum deductible of $1,700 for self-only coverage, or $3,400 for family coverage. If your employer does not offer an HDHP, or if your healthcare situation makes a low-deductible plan a better fit, young children, ongoing treatments, chronic conditions, then the HSA is not accessible to you regardless of its tax advantages. The 401k has no such restriction. There is also a penalty structure worth knowing. HSA withdrawals for non-medical purposes before age 65 come with a 20% penalty plus ordinary income tax. The 401k penalty for early withdrawal is 10% plus income tax. Neither is attractive, but the HSA is more punishing if you need the money before retirement for non-medical reasons. Given everything above, here is the order that maximizes your tax efficiency while capturing every available advantage. Step 1. Contribute to your 401k up to the full employer match. Full stop. Get every dollar of free money before you do anything else. If your employer matches 4%, contribute 4%. If they match 6%, contribute 6%. Step 2. Max out the HSA. If you have access to a qualifying HDHP, contribute the full $4,400 for individual or $8,750 for family coverage. Invest that balance immediately. Start the receipt-keeping strategy from day one. Step 3. Return to the 401k and increase your contribution toward the full $24,500 limit. The 401k's pre-tax benefit still shelters more income per dollar than a taxable brokerage account, and the higher your income, the more valuable that deferral becomes. Step 4. If you have anything left, Roth IRA, up to $7,500, then taxable brokerage account. Most people cannot execute all 4 steps every year, but the order matters. And steps 1 and 2, the 401k match and the full HSA, are the 2 that most dramatically separate high-efficiency savers from everyone else. And here is the specific number that puts the entire comparison in one frame: what $8,750 in an HSA is actually worth, compared to $8,750 in a 401k over 30 years, after all taxes are paid. Let us run the comparison cleanly with identical numbers. You have $8,750 to invest. You are 35, in the 22% federal bracket. Both accounts earn 7% annually for 30 years. You retire at 65 and use the entire balance to pay medical expenses in retirement. $8,750 in a 401k, annually for 30 years. At 7%, $8,750 per year compounded over 30 years grows to approximately $882,000. You withdraw it for medical expenses in retirement at a 15% effective federal rate, a reasonable blended rate for a moderate income retiree. Tax owed, approximately $132,000. Spendable, $750,000. $8,750 in an HSA, annually for 30 years. Same 7% return, same $882,000 balance. Withdrawn for qualified medical expenses, tax owed, 0. Spendable, $882,000. The HSA delivers $132,000 more in actual spendable money on an identical investment over an identical period, at an identical return, because the triple tax advantage eliminates the final tax hit that the 401k cannot escape. Research shows the HSA provides approximately 33% more after-tax value than the 401k over the same period when used for medical spending, simply because qualified medical withdrawals are tax-free. That 33% advantage does not come from picking better stocks or timing the market. It comes from choosing the right account for the right type of spending in retirement. Here is the complete picture in one frame. The 401k wins on contribution limits. $24,500 versus $8,750. It wins on the employer match, which is the highest guaranteed return in personal finance, and must be captured first. It wins when you do not have HDHP access, and it wins when you are close to retirement, with limited compounding time remaining. The HSA wins on tax efficiency, triple advantage versus double. It wins specifically on healthcare spending in retirement, where it delivers approximately $132,000 more in spendable money on the same $8,750 annual investment over 30 years. And it wins on flexibility in retirement because there are no required minimum distributions, and the receipt strategy can generate tax-free withdrawals for effectively any purpose if you have been collecting receipts for years. The answer is not either or. It is the sequence. 401k to the match, HSA to the max, 401k to the limit. Execute that order, and you are using both accounts precisely as the tax code intends, and building as much tax-free retirement wealth as possible from every dollar you earn. If this gave you a clearer picture of how these two accounts actually work together, every week we run the exact math on the decisions most people are guessing at.